Welcome to Turning Hard Times into Good Times. I am your host, Jay Taylor, and I like to remind you each and every week I'm also the author of a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks. And my company, Taylor Hard Money Advisors, is in partnership with Chen Lin, who publishes What is Chen Buying? What is Chen Selling? And you can subscribe to both of those letters by going to miningstocks.com, miningstocks.com, or you can call our office here in New York City during normal work hours, 718-457-1426, 718-457-1426. I do want to thank each of you for listening to this show and encourage you to continue sending along your questions, comments, criticisms, and praises to questionsfortaylor@gmail.com, questions4taylor@gmail.com. Also, invite you to go to my website, jtaylormedia.com, where we have a lot of very good articles, some of which yours truly has written, but other contributors as well. I do want to thank Dynacert and Metanor, our sponsors for today's show, for making this show economically viable. Metanor Resources shareholders have suffered a lot of dilution during the recent years with the horrible gold markets, but they have made a discovery that is very promising, and the share price has been beaten down very dramatically, along with most of the mining shares. But the new discovery, combined with an $1,800 gold price in Canada, is perking things up a bit for this company. So it's one you may want to pay some attention to, and I will be talking to Ron Perry on this show in the near future for an update on Metanor Resources. And I also today want to welcome Avino Silver and Gold Mines back as a sponsor to this show. And Avino is a company under the leadership of David Wolfen, and he's doing a great job there. I think David is doing a wonderful job in increasing silver and gold production in Mexico, and now they're getting ready to start to expand and grow and open a mine, the Braylorn Gold Mine in British Columbia. I do expect to have David on my show in the near future as well. I think perhaps early April, he'll be coming on to give us an update on what's going on with Avino Silver and Gold Mines, and certainly with an improved gold environment, things are starting to look up for the gold miners. Just one more note before we get into today's show. Ellen Brown, who has been a guest on this show several times in the past, will be with me again next week to discuss an article that she wrote, and it is posted at J. Taylor Media. The title is Exposing the Libyan Agenda, a closer look at Hillary's emails. Hillary Clinton's emails reveal that the reason the U.S. and NATO went to war against Gaddafi had nothing to do with Gaddafi feeding Viagra to his soldiers, as we were told, and encouraging them to rape, to use rape as a weapon, essentially, against certain females, or even did it have anything to do with the revenge of the airliner that Gaddafi is accused of having downed decades ago. In fact, thanks to Hillary's emails, we now know that the murder of Gaddafi and thousands of other people in that country had everything to do with defying the IMF in using a gold-backed dinar to compete against the petrodollar. So thanks to information revealed from declassified emails from Hillary Clinton, we now know the truth about the motives for going into Libya. It's a very well-explained article, and I do hope that you'll go to J. Taylor Media to read this, Exposing the Libyan Agenda, a closer look at Hillary's emails. We may get a chance to ask Mr. Angdell this afternoon, later in the show today, whether what he might think of that notion as well. So in any event, let's turn to today's show. I've titled today's show, A Bankrupt U.S. and NATO, What Does It Mean for Gold? And as I mentioned, William Angdell will be with me. Ivan Bebek will be with me to talk about what's happening with his company. And also Michael Oliver is with me and will be talking to me and giving me his update on the gold and equity markets in just a moment. The U.S. and NATO are, for all practical purposes, bankrupt, and there is little hope for the financial restoration, I believe, because the monetary system is built on the sinking sand of debt. When Nixon took us off the international gold standard in 1971, he not only paved the way for massive reallocation of wealth from those who create it to the miners, manufacturers, farmers, and inventors, but he also paved the way for bankers to destroy capitalism by destroying the price discovery of capital by manipulation of interest rates. As a result, the global economy is becoming ever more insolvent day by day, not allowing market forces to work, dislocations that threaten to throw the world into a depression, the likes of which may make the 1930s look like child's play. I regret to say a virtual certainty, I'm afraid, for America and the world, save for the grace of God. With the massive intervention against free markets by the Federal Reserve and other central banks around the world, all of which have signed on to Keynesian lies, the middle class in America and Europe, as well as everywhere, basically, are revolting against that so-called extremes are arising on the political front in Europe and the United States. And really, political status quo is being threatened, I think, more than I can recall at any time in my 69 years of life, and that would include the tumultuous Vietnam years as well. Well, as I noted, William Engdahl will be with me in about 35 minutes or so from now to talk about a recent article he has written titled "Behind the Facade: America, the Bankrupt Hegemon." Now, I believe William will have some things to say also about Russia and China, how they're building up their gold reserves to protect themselves from what those countries see as an inevitable decline of the Western economies as a result of the irresponsible economic and warmongering policies of the United States and NATO, especially since the fall of the Soviet Union. And I believe William may also have some interesting views on Donald Trump. We'll certainly want to hear what he has to say as someone who resides in Europe. In a few minutes from now, as I mentioned, Ivan Bebek will be with me. He'll be talking about the company there that he's leading up. He's done a remarkable job in the past. He and Sean Wallace and their new venture up in the Nunavut is looking extremely good. So we hope that you will stick around to listen to what Ivan Bebek has to say in just a few minutes from now after a first commercial break. But now we do have Michael Oliver with me. And I want to thank you again for joining me, Michael.
Oh, glad to be here.
Always good to have you. I want to ask you about the equity markets. I see, it just seems to me, Michael, they don't go down. Equities only stay flat or they rise. I know you've made the point that they've gone nowhere in the last year or 2 years or whatever, but there seems to be continued optimism and a belief that they're never going to decline. What are your thoughts? What are your structural models telling you right now about the S&P?
I think the rally is about over. Clockwise, it may be this week. My best guess is that you top this week. But let me take you back a bit. Let's go to 2008. Exactly the same configuration of technical factors occurred. Again, there's always fundamentals, and I'm aware of them. I have an Austrian bias and so forth, but I don't let that cloud my view, whether it's up or down in a given market. But in 2008, when we closed out 2007, the price was at 1468. It was 100 points or more above the low of the year, and about 100 points off the high. So it was squarely in the middle of the year. It had been a sideways up-down year. The Fed had intervened in August to drive prices to a new high in October of 2007, and the market wobbled off a bit by December. I noted at the time that if you opened at that price in the year 2008, you would break and blow the bottom out of annual momentum. 3 prior years of momentum lows is where you measure price against, in this case, a 3-year average, were violated as soon as you opened 2008, and the market immediately dropped 200 points. Okay, now, what happened next? First off, after that initial price break, which was a statement sell-off about what was ahead, you had destroyed your annual momentum trend. It was now down. And you had also taken out several price lows that preceded that. Specifically, there were 2 lows in 2007 at the 1370 price level, and we took those out by about 100 points. Then, and only then, the market rallied. And it rallied 14.5% from that early year low. Almost got back up on the year, and frankly, had it gotten up on the year, it wouldn't have mattered to the momentum situation. But it's very similar to what we're seeing now. So far, we've had an 11.5% rally as measured from the recent low. I think it is a bear market rally. I do not trust it. I think all it's doing is further soothing the bulls and obviously upsetting the bears. But it's just a process that happens many times after a top is made. It is not simply a matter of going from the high to the low. It doesn't happen that way. I regard this as a counter-trend rally.
All right, so people should people shouldn't get too comfortable with owning the stock market as a general rule right now, I guess.
That's my opinion. I think the damage has been done from momentum. Price can flip-flop around and try to convince you otherwise, but it is doomed. It's a matter of when we roll over again. I can say from a price chart point of view, you could even forget momentum at this point. The recent highs that we exceeded was a shelf of highs on the S&P at 1950 price level. We're just above 2,000 right now. You ever close a week out much below 1950? Assume it's over.
Okay. All right. Well,
assume the rally's over.
All right. Well, two and a half minutes left to go, and that's about all we have here for the first segment here. I want to ask you about gold. Regarding gold, there still are a lot of Wall Street pros calling for a sub $1,000 price, but you don't seem to be buying that idea. You stated in your weekend letter that you, to your paid subscribers, you said, and I quote, "I think the clock is running out for those who want and expect a collapse." End of quote. Why are you backing? Not backing.
In fact, I'm just about to issue a report when we hang up here that I prepared this morning on the S&P and gold. But on the gold issue, I think we've had what can be called a correction standing in place, where we surged after an annual momentum of gold broke out early February, and quarterly momentum, massive basis that didn't even look anything like what the price chart looks like. Price soared. The first initial high took us up to 1260 rapidly. In a matter of about 2 weeks, he went from the low 1100s to 1260. At that point, the market went into a congestive phase on price, where you could basically draw a line through about 1230 price, which is where we've been trading today. And that intersects the weekly action of the prior 5 weeks and this week. In other words, we're oscillating around a sideways level. Meanwhile, momentum is correcting from a very overbought condition, which existed 6 weeks ago. But rather than sell off, to cool off the overbought condition, the market has simply decided to cool off in place, a sideways congestion, in other words. I don't buy into the bear arguments. I think the bullish breakout we had in February down in the 1140s to 1160, this is based on annual momentum, was a statement that cannot be ignored, and that the new trend for gold is up. All we're suffering right now is a congestive phase.
All right. Well, then that's good news for those of us who are long in the shares as well, I would guess.
Yeah, they're even, of course, acting better than gold on a percent basis. The gains from their low have been quite strong. GDX is what I generally use to measure that. GDX, for example, is 19, and I think this year you could see 39.
Excellent. Well, we'll look forward to that for sure. Michael, I know you just mentioned you're going to put out a report as soon as we hang up here, as soon as we finish talking. And you also noted that you would allow my listeners to go to your website, it's OliverMSA.com.
OliverMSA.com, yes.
And they can request a sample copy of what you put out today, right?
That's correct, free sample.
Okay, free sample. It's hard to beat, folks, and I'm one of those people that like to read, must read. I read everything that Michael sends, and also very much use his work to do my own trading. So I want to thank you for that very generous offer, Michael, and we'll look to talk to you again sometime in the near future.
Thank you, Jay.